Exactly. I think when you have the underlying settlement asset move as quickly as something like Bitcoin does, either fractional reserve banking doesn't make sense, or the ratios that are workable are so much lower than the current ratios we have now that you can get up to, like, say, 23 to 1, for example. That type of ratio completely goes away when the underlying settlement asset can move very quickly, and you don't really get any advantages other than yield for having it in one of those.
In this video, we're going to be going over an interview of Lyn Alden taken by popular YouTube channel What Bitcoin Did. Lyn Alden is an investment strategist, writer, and speaker who is known for her expertise in macroeconomics, investment analysis, and the financial markets. In this video today, Lyn is going to be talking about how technology is evolving at an insane rate, and with technologies such as Bitcoin, we could replace the traditional fractional banking system. Make sure you stick around to the end of this video to find out why Lyn feels so strongly about newer technology like Bitcoin providing more value than traditional banking systems. Also, don't forget to drop a like, subscribe, and leave your comments down below.
Yes, that's exactly what you're doing, and basically, it's one of the cheapest source of funding available. I mean, that's a key thing that a bank does, is that they're able to borrow interest very, very low, and then they're able to lend it out at higher interest rates and collect that. And there's very different types of banks. There are investment banks, there are commercial banks. Some banks are very simple, some are very complex. But at the end of the day, what their primary purpose is they're providing checking services, they're providing saving services, they're providing services. But at the end of the day, those are a liability for them, an asset for us. Basically, most of the modern financial system that we built up over a long period of time is this kind of arbitrage where banks are arbitraging the fact that they have a bunch of depositors that are coming and going, but in aggregate, most of their total assets, I mean, their total liabilities are not changing very frequently, and so they have this kind of permanent low cost source of borrowing that they can lend out for longer periods of time in slightly higher risk capacities. And by having diversification, by having sufficient liquidity on hand to withhandle withdrawals, most of the time they're fine, and they generate that income, and then they pay themselves, they pay their shareholders. It's basically a big middleman operation, and that's how things work. And obviously, back a long time ago, this was a really valuable service because if you're talking about, like, say, depositing gold coins at a bank and getting like a banknote for them, you're speeding up, you're getting better divisibility, you're getting all these services. Even today, many of us use banks because we're getting something from the relationship. We're able to, connect into this big global set of ledgers, move money around, not have to store a bunch of physical cash like in our home. Obviously, there are some recent alternatives that we can use, like, say, Bitcoin, for example. But prior to Bitcoin, this is kind of the best we have, and so that's the world we live in. I generally separate beneficial and harmful as that's one axis versus inevitable or not inevitable. So I think kind of the way I put it is that it's inevitably going to happen, at least with the current and the prior level of technology that we had for the past couple centuries. That is essentially, anytime you have a custodial service, like, you're depositing your gold, you're getting claims for that gold at a future date, those people inevitably realize, wait a second, most people don't come and take the gold out at the same time, and therefore I can use this. And then you start to get market pressures, like, all these different custodians are holding your gold, and they're all charging fees. And then someone says, wait a second, if I lend 20% of this out, I can generate some income from that, and then I can charge my customers no fees, and they all want to use my service instead of my competitors. And if they don't disclose that to customers, it's fraud. But if they do disclose that customers might say, well, I mean, if you're loaning out 20% of it, that sounds reasonable. If they're, secure lending practices and so forth, it's 80% backed by gold, is 20% backed by, less liquid loans. Sure, I'll take that trade off. And then another one might come along and say, we're going to lend out 40% of it. And not only are we going to make the custodian free, we're going to then pay you a little bit as profit sharing. Right. And so there's kind of, I think it's one of those things where if you have a mismatch in speed between the claims and the underlying, right? So gold is slow and bank accounts are quick. You're going to get that arbitrage, and banks are going to make use of that arbitrage. That's why once fractional reserve banking was a thing, it spread everywhere. And so I think it's one of those things where it's inevitable in that current era of technology. Basically, market forces are going to keep pushing in that direction. Whenever they push it too far, it's going to blow up. And so it's less that I view it as good or bad, is that I view it as inevitable. Now, I think there are ways, I think, if you had a bear asset that could settle quickly, there's less of a reason to fractionally reserve it. And basically, whenever it attempts to be fractionally reserved, it's much more likely to break. It's, because people can pull it out quicker. There's less of a reason to put up with that risk, right? So I think that basically, as technology changes over time, with Bitcoin, for example, I think that can squeeze out the need for it.
Uh-huh.
But I think it's basically inevitable over the past number of centuries that it's going to be there. When you have the underlying settlement asset move as quickly as something like Bitcoin does, either fractional reserve banking doesn't make sense, or the ratios that are workable are so much lower than the current ratios we have now that you can get up to, like, say, 23-1, for example. That type of ratio completely goes away when the underlying settlement asset can move very quickly, and you don't really get any advantages other than yield for having it in one of those. So for example, back in the free banking days, besides yield, the advantage you got for putting your gold in a bank is, one, you didn't have to worry about custody it anymore, and two, you're now tied into this telecommunications connected ledger system, and you can move claims around faster. So you put it in, you get higher velocity from it. But in a world where it is safer to secure the underlying, let's say, for example, Bitcoin multisig, you only have to worry about storing mass amounts of gold in your home. And two, if the underlying moves just as fast as bank ledgers do, then there's less of a reason to ever put it at risk in any sort of fractional reserve way, or at least any significant fractional reserve way. And so I think that's the changeover. I mean, the short summary is that I emphasize hard assets, right? Or I'm long things that are scarce, and I avoid or I'm short things that are not scarce, right? So I own things like energy pipelines, energy deposits, good cash flow producing companies, gold and Bitcoin, right? And then I either avoid things like holding massive amounts of cash, or I have a low interest rate mortgage, for example, so I'm effectively short the currency. Now, in periods of time, like if I think, for example, they're going to tighten so much they're going to cause a recession, then cash could be really good for, like, a 12 to 18 month period, because everything else does worse. So there certainly are periods of time. Like right now, I think I have some cash. Basically, I focus on hard assets, but I also focus on diversification and maintaining liquidity, so that if there are these kind of periods of volatility, I can rebalance into those things. And it partly comes down to not being able to know the future, and then two, you have to kind of take actions that come and go. I mean, there could be regulatory actions against something like Bitcoin. There could be wars that break out. So it's basically just diversification into a number of things that I view as being scarce and useful, and avoiding things that I view as being abundant or not useful.